Now that we covered all the admin, it's probably a good idea to have a look at, well, especially for this topic, to go back to the bigger picture and just see how this fits. And it's a really important one for intangible assets, because one of the things in the big picture, and I'm going to focus primarily on information here, is why we have accounting information and why people use it. And the preeminent reason, I'm actually reading a book on the use of IFRS at the moment, the primary reason we have accounting standards and we have accounting information that the regulators see is for equity users to be able to make decisions, and primarily investment decisions. If you're a current investor, do you sell out of the stock? Do you buy more stock? If you're a potential investor, do you buy stock? That is ultimately what we're trying to do. But where intangibles are really interesting is, and this is why knowing the rules is quite important, accounting financial statements are not the only source of information which is useful for making those decisions. And where knowing the rules is important is knowing what information is in those financial statements, and knowing what information is outside of those financial statements. And also understanding why that's the case. So quite a few intangible assets are, for a variety of reasons, excluded from the financial statements. So even though Qantas, and we looked at Qantas's balance sheet last week, even though Qantas's financial statements have something like $750,000 worth of intangible assets, there are probably, and actually with Qantas, as we'll look in a little moment, there are probably things which are not recognized but which are important for Qantas, which are intangible assets but which are not recorded on the books. And so we've got to understand why that is and understand where else you'd find that information. Now the topic is fairly similar to last week. Actually, it's almost, not fairly similar, it's very similar. Because assets, especially intangible assets and property, plant, and equipment, are actually really similar. It's just literally the tangibility is one of the just main things which differs between them. But in a lot of ways, from an accounting point of view, there's a lot of similarities between them. So it's important when you're sort of reviewing all this stuff to sit these two topics together and try to find out where the differences are, and also think, why are these different? And also save you a fair bit of time when you're preparing. So we're going to look at what the framework definition of an asset is, what information do they provide, why are they potentially adjusted, the role of regulation, and what 138 is actually doing. So I know we've seen this before, but as any good sort of person in PR or marketing knows, if you want a message to get across, you keep, repetition is key. An asset is a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow. Tangibility as part of that is not a key feature. It is not something which is seen as an important characteristic. So you can absolutely have something which is an asset and satisfies all those criteria, but you cannot touch it. And we're going to explore those today. We're also going to explore this definition in a little bit more detail as we get through to the standard. But intangible assets are identifiable non-monetary assets without physical substance. We know assets have to have control, there has to be a past event, and there has to be future economic benefits from the point of view of the framework. So again, this isn't part of the standards. This is what the AASB considers an asset to be from a framework perspective. But the really neat thing is, as we roll down into the standard itself, we're actually going to see a lot of these ideas transferred across, which is quite nice. So an asset is recognized in the balance sheet when it is probable that the future economic benefits will flow to the entity and the asset has a cost or value that can be measured reliably. So in a nutshell, we've got control, a past event, future economic benefits are probable, and a cost or value which is reliably measured. And let's consider that in view of a number of different types of things people consider as assets of businesses. Marketing, advertising. Companies have argued that advertising and marketing is an asset of the business. Now the issue with that is, at least in my mind and from a conceptual framework point of view, that there isn't necessarily a good link between what's going on here and any benefits which are coming out of that. Now, I've used this as an example, and I know it's going a little bit further back. So where the bloody hell are you campaign? Does anyone, I know it's going back to about 2006. Do people remember that campaign? Sort of, some people yes, some people no. About the only thing it was really memorable for was that it was the launching pad for Lara Bingle's career. Now, you actually look at the ad and you look at the campaign, and she featured not that much in it, so I don't actually understand how that worked out. But from an accounting point of view, this is an ad commissioned by the Australian government through Australian Tourism. It cost $180 million, this campaign. Now, they showed it in 3 primary markets around the world. They showed it in Japan, they showed it in Germany, and they showed it in the UK. Now, I don't know if I've got any people doing marketing. Marketing is a major, but I'm pretty naive around these sort of things. But I would expect the reason why you have marketing, why you have advertising, is to help you sell stuff. Would that not be would that be a fair assumption? I don't know. It seems to me that that's kind of, yes, you may want to get awareness and you may want to get branding out of it, but ultimately you want to be able to sell things. The 3 markets where this was shown, fewer people turned up after the campaign happened in those particular markets. So in Japan, they had something like a 5% drop in visitors after the campaign got shown. In the UK, it was something like a 2% drop, and I can't remember what Germany was. So actually, they showed this campaign, and year on year, fewer people came after that. To my mind, that's something wrong with the campaign. In a couple of markets where it wasn't shown, in China and the US, more people turned up year on year. So you can't absolutely say, was it the campaign? But certainly the campaign didn't seem to provide any sort of tangible benefit in the markets that it was shown. And the point of all this is, you can get some really low-cost advertising, and it has a really good economic effect. You can have some really expensive advertising, and it may give you absolutely no good outcome. The link between the two, and I suppose if you think about it from a statistical point of view, how good is that correlation between what you spend and what outcomes there are? And at least the standard setters see it as it's not close enough to say you can capitalize this spend. You have to expense it out. Brand names. Coke or Pepsi, are they different? I don't know, this is a genuine question. Do you consider them different? In blind taste test, do you reckon you could pick which is which? Yeah, I reckon I could too. I reckon I actually have a preference for Pepsi, but that's probably due to all my time working at KFC and scabbing drinks out the back. But yeah, there probably is a marginal difference between the quality of the products. But a lot of people will buy Coke because it's Coke. Like, the brand name is important. And if you think about a lot of products, people will buy the product and people will pay premiums on the product because it is what it is. And if you look at a lot of high-end fashion, some of it, people spending $500 on a t-shirt, I just don't, I actually don't get that. Because obviously the t-shirt quality itself cannot warrant a $500 cost, but people will pay it. Brand names are important. Does the company control the brand? Absolutely. Is it a result of a past event? Yes. Are the benefits probable? I'm saying that's probably a little bit closer than with advertising. The cost of a brand, I don't know, if it's an internally generated brand, that may be quite difficult to determine. If it is a brand valuation, that's almost impossible to come up with a reliable valuation for it, because that is an external party doing that. And even then, how you value brands is quite difficult. And I've seen some of the metrics of how you do it, and I don't think it's all that reliable. Customer satisfaction is, people of the business, they're important too. How you treat customers, how you deal with stuff. And you will not see that included in a balance sheet anywhere around the world. And you can consider why that's the case, but are those things important? Is on-time running for airlines and for trains, is that sort of stuff important? Is customer satisfaction important? Absolutely. And you will see that sort of information disclosed, but it will not be as part of the financial statements. So knowing where information is and what information is important is a useful thing to know.